All right, good afternoon and welcome everyone to today's US market update and our second quarter earnings preview presentation. My name is Kelly Main, Associate Portfolio Manager, and here with me today are Fortrend CEO Joe Forster, along with our portfolio managers Chris Solomon and Stephen Lyle. We welcome questions throughout the presentation. For those tuning in via Zoom, please feel free to contact us via our email or contact number as per the Fortrend website with any questions. With that, I'll now turn the presentation over to Joe.
Now, before you turn to me, Kelly, can you ask people on Zoom if they can hear and see okay? Is everyone see and hear okay? If you can't, send a message.
Yes, Lola raised it.
It's all okay.
Yes.
Okay. Who is Lena Khan? Is the question. She's a 32-year-old woman from Pakistan, and she was appointed as the chairman of the Federal Trade Commission. And she's a very interesting woman for 32, having just been given this very, very powerful position. What we're seeing, of course, since January is the top 5 companies in the S&P 500 being Amazon, Google, Facebook. What are the 5? The Microsoft, Alphabet. Yeah. So they went from 20 to 24% of the total S&P 500, and there was a lot of noise in the election, where, and particularly Elizabeth Warren was saying that big tech should be broken up. She was actually referring back to Lena Khan. So I want to talk a little bit about Lena Khan and her power in the marketplace and how she'll be looking to break up big technology and the implications of that. The S&P up 3.5%. So this is still the Fed trade. This is still the Federal Reserve pumping all that money into the market. Earnings estimates are up 1.7%, but that does push the PE up 2%. Excuse me, 2.1. And the reason the PE is going up is because interest rates are going down. So the big debate this period is really about, is inflation transitory or is it sticky? That's the big debate going on. And towards the end of the month, it was decided that it is transitory and it is not sticky. Okay, and that is what we said in January and February. We said that the stimulus coming through from the Biden administration, the $1,400 checks, will cause a bump in economic activity at this time, and that wave will come back down and we'll have a trough. So we're expecting that these dislocations causing big increases in the price of lumber, oil, secondhand cars, because of course new cars have to have chips and they can't be produced, so secondhand cars are going up in price. And so you've got a lot of supply issues in the supply chains causing inflation, and it is transitory in our minds, clearly transitory. So who is Lena Khan from Pakistan? I want to talk a little bit about this paradox. So the paradox, the Amazon antitrust paradox, it got Elizabeth Warren's attention. And Elizabeth Warren, of course, got Joe Biden's attention, and Joe Biden appointed her as the vice chair, as the chairman of the Federal Trade Commission. But the paradox says that the Federal Trade Commission has focused on lower prices being the best indicator of having a competitive landscape. If consumers are benefiting from lower prices, that's our net result and what we're looking for. And if you click through on the link here, you'll see that what Lena wrote when she was at Yale was that the paradox is that Amazon controls not just bringing the prices down, but they have inventory, they have logistics, they have supply chain, and they have a number of other things that are the auction process. So it's the whole market infrastructure, and that the antitrust organization needs to look at the market infrastructure, not just the end result, which is the prices. And there needs to be a big shift in the whole thinking of antitrust legislation. So that's why she got the pick. Now, she will crack down on big tech, and I want to go through how those companies would likely be broken up. And it isn't necessarily a bad thing. For example, we saw that eBay spun off PayPal, and PayPal is now one of the most valuable companies in the United States, and it wasn't when it was part of eBay. And if Ant is spun off by Alibaba, that would be a similar analysis. But if Apple sells Apple Store could emerge as something gigantic.
And I potentially, an equal to the handsets and other things.
I think it's worth noting that Lena Khan was approved by the Senate with 68 votes. So it was a bipartisan approval, which I think indicates that there are some Republicans who are on board with this notion of breaking up some of the big tech names.
And I think politicians don't like big tech that might put Russian noise into an election process, and they want to have the big tech not dictate political outcomes by supporting any candidate. So there's concern about that.
Joe, they say how they were going to do it. With previously with the Alcoa years ago, they used the Sherman Act to break it up.
Mhm.
So do the same thing with, say, Amazon or.
I don't know. I'm not
Well,
sure.
what they have to do is pass legislation, I think, in these instances, because the Sherman Act probably wouldn't apply. It's out of date,
Oh,
because consumers aren't actually hurt by
I see. Yeah. Right.
Yeah, so for the last couple of decades, the standard or the lens that antitrust enforcers have been using is a consumer welfare standard. And to the extent that these big tech companies provide services and products for free, or eliminate a lot of supply chain costs, disintermediate supply chain costs, consumers benefit on the one hand, without recognizing that data is being sold for advertising. But that standard that's applied by antitrust is going to be changed. And Khan's already made some changes within the FTC in that regard.
it'll have to be changed. It might not be, but if they want to break these things up, then they'll have to change the way they approach it.
And the counterbalance is the Supreme Court. So the law has to be, go to the Supreme Court potentially. And if the antitrust lawsuit by the Federal Trade Commission is brought against a big tech company and that's fought in the Supreme Court, we have a Supreme Court that has two recent appointees by Republicans, being Brett Kavanaugh and Amy Coney Barrett. So you have a Republican influenced Supreme Court. So the two will go to battle over the next 10 years. Biggest movers in the market, Biogen. I joke, why I can't.
So if things are spun off, what happens to the valuation?
They could go up. It could go up because the parts could be greater than the whole. But it's hard to tell how that will unfold now. So I look at Apple and splitting off Apple Store, and I think that could add value. I think that how do you spin off YouTube and Maps from Google search and not retain all that collective data? I don't know. So I think it's situational. Amazon would argue that customers would have to go to two different places to buy stuff. Maybe they'll have to, I don't know how they split that up because, they're not allowed to sell books.
Maybe they shut off the cloud.
Yeah, but if you're going to split anything off, you split off the most profitable cash.
And that'd be cloud. Yeah.
Yeah.
That'd be cloud. And that'd be Amazon Web Service, AWS. And that is just, you can't stop making money. I mean, as I've said many times over the years, they can't not make money with that. I mean, Amazon likes to not make money. And with web services, they can't do that. Biogen, the way we remember this, they've got it. We say we can't remember why they went up because it's got a new Alzheimer's drug. So that's the way we remind ourselves. I remind myself what's going on with Biogen. This drug was ineffective in tests in Japan and is potentially not doing anything to cure Alzheimer's, but maybe slowing down the damage done by these proteins in the brain. But it's not harmful. So it was a real surprise that Amgen's drug was approved and approved on the basis, not that it's doing good, but that it's not doing harm, which is a big shift for the Food and Drug Administration. And NVIDIA, they are $5.5 trillion market cap, 550 or something now. I mean, they're really taking off in a big way. So NVIDIA was very strong. We've seen a lot of strength here in Occidental and in Marathon. So some of the cyclical stocks are up there. Adobe, one of the things is that we're talking more about inflation, but the inflation does look at the beginning of the month like interest rates would have to go up to hold back inflation. Then towards the end of the month, people said, no, this is transitory. So the 10-year treasury went down and all the growth stocks had a big boost towards the end of the month. So particularly we see Amazon, we see Google, we see all the big growth stocks up towards the end of the month. So that includes Adobe. Nike just had tremendous earnings. I mean, they were supposed to make 50 cents and they made 90 cents. Do you want to talk about Nike and their big burst?
Yeah, so they reported earnings out of cycle. I think that's why they've got an asterisk there, and raised their guidance. Their results they're really benefiting from this Nike direct approach, direct to consumer, cutting out the wholesale, which is enhancing their margins. And the revenue growth in China had decelerated to about 17%, but it was not as bad as expected because I'm sure everyone's seen the tensions around companies sourcing cotton from certain regions in China, and they have to sort of navigate any company comments and changes to their supply chain. So that was less bad than feared. Very, and they're just humming, doing very well.
Yeah, doing extremely well. And I think their revenues were 15% ahead of expectations, but profits were almost double expectations. So it really flowed through the bottom line. And, you know, I'm going to ask Kelly to do this later, but how is Nike similar to Louis Vuitton? You know, I mean, they both sell a collectible or a fashion statement. I mean, they're different ends of the market, but, you know, you buy a Louis Vuitton bag or, you know, so many different brands under the Louis Vuitton name. And then Nike really just has the one shoe, right?
And
What's that?
sporty, athletic wear.
Oh, yeah, clothes. Yeah. So, okay. On the downside, Allegheny Technologies, Newmont, Barrick, Freeport. So some of these cyclical stocks are down. And Carnival was down on concerns about delays in the reopening. But I wanted to point out what's going on with BHP, because we don't follow BHP, but we monitor it. And there's something very interesting going on here. You can see that in this year, the earnings estimates for BHP have gone from about $3 to about $7. So there's been, and that goes across all the steel companies. So we're seeing increases in earnings estimates for US Steel, Allegheny, I mean, big, and BHP is a much more diversified company than those US. So we don't follow, but we monitor BHP. And I want to show you that the stock price is absolutely flat. And so why the earnings estimates double and the stock price flat? You got an answer for that one, Peter.
I wish I did.
Well, I'll give you the answer. It's a scam, is the truth. And what happens is that the institutional investors saw this coming in the prior year. And the Wall Street strategists had to catch up with the institutional investors. Okay. So the instos knew, and they bid up the stock last year, and they're actually pushing Wall Street strategists. And the Wall Street strategists in this case are trailing or following what's going on. So the rise in the stock price was in anticipation of these earnings estimates, and the Wall Street analysts are behind the curve. Okay, so now the Wall Street strategists would be selling the stock to retail customers. So there is this, you know, you want to service your, as a Morgan Stanley or a Goldman Sachs, you know where your money comes from. It comes from your institutions, not from your retail. So you're going to get your institutions in early, and you're going to get your retailers in at the top. So it is a little bit of a transfer of wealth from retail to wholesale. There's a bit of, you know, who's my more important client stuff going on there. But that's why is that the strategists, the Wall Street analysts are catching up with the institutions. And it's a big delay. It's a big lag there. Yeah. So I wouldn't expect the stock price. I mean, that's have to keep going quite a bit for the stock price to be surprised now. Yeah.
There's a spin-off story there too. Though.
Well, I don't know. I don't.
South 32.
Yeah, I don't follow BHP, and I wouldn't know. But what I do know is that US Steel, Allegheny, and Nucor have bigger percentage increases in earnings estimates. So it's all the steel companies in the US, and BHP is much more broadly diversified, but they all look the same. Big increases in earnings estimates, flat stock prices to down stock prices this month for Allegheny, right? So, but if there's a spinoff or an M&A or something else going on at BHP, you know, I deliberately look at it very broadly and cursory. They're doing some M&A work.
This other thing was spun off for about a year ago, I guess. I think so. And its share price has gone from roughly $1.80 to $2.80.
Would they spin off?
A whole lot of smaller assets that weren't getting much attention.
So they weren't like a copper asset or an aluminum asset or an oil
They're
asset.
a mixture
Just a
of,
bunch of stuff.
yeah.
Okay.
a
And does
mixture
that
of
leave
minor
BHP
mines.
more of a steel company?
No, they weren't in steel.
That makes them more of a copper company?
It makes BHP more of a copper
It makes
company.
them a copper company.
Yeah,
Okay.
yeah.
Okay. So it's comparable to Southern Copper.
Mm.
Okay. Okay. See, I don't follow it. Okay. So it's really demonstrating a shift to institutional investors. And the same is going on with Cleveland Cliffs and US Steel and Nucor and Allegheny. Okay, inflation, is it transitory or sticky? The stimulus caused a big bump up. Okay, and we saw a big bump up in steel, right? We saw a big bump up in oil, read on secondhand cars, and a lot of different things. So I've been guiding our clients to expect that this is a bump, not a sticky inflationary change. Okay. Now the Powell would argue that these rapid shifts are causing some disruptions in the supply chain, and that's why these rapid shifts are causing inflation because there are bottlenecks in the supply chain. But if we look at wages, people would argue that if you have to increase the wage that you're paying somebody, that would be more sticky because you can't really bring those wages back down. So when we start to look at those companies that have the highest number of employees for sales, or who has fewer sales per employee. And the companies that really are very dependent on wages would be Yum Brands China, being by far the most, because they have lower wages there and more people and very dependent on minimum wage people, but also Darden Restaurants, Marriott Host, Starbucks, McDonald's, FedEx employs a lot of people. So the revenues per employee is pretty low. And if you go into sectors of the economy where it's very high sales per employee, then those increases in wages are not going to be very significant. Now, oil and energy fit in there, but they're not really going to get captured in this analysis so much. But it does say that low-income people don't really matter to the stock market. So even though we have wages going up and down or unemployment going up and down, it's not having a big impact on the stock market. So I'm going to let Steve say that before I say something politically incorrect.
Exactly right. Yes. Service jobs are not relevant to the stock market present.
Yeah.
They're not driving demand. And I think moving forward, the push on labor costs could make a difference. Because as you said, that is a sticky inflation. When people's wages go up, it's very hard to reduce those if things change.
You know, this is just a personal belief, but I wouldn't mind seeing minimum wage go up 20 or 40%. Well, we want to help these people who work rather than give them unemployment and handouts. I'd much rather see a big increase in minimum wages, personally. But you know, that's a personal value. But not that that's going to happen. But Joe Biden would like to see that happen.
If you own some McDonald's restaurants, you might have a different opinion.
Yeah, maybe. Yeah, maybe. Healthcare and energy are the least dependent on wages. And especially if you've got doctors, they're not dependent on minimum wages. So we're talking about McDonald's employees or Darden or Starbucks or Walmart. Restaurants, transportation and hotels are the most sensitive. And if we see, like cleaners or people working at the counter, a lot of the service people in hotels are at those lower minimum wages. Some industries have a wide range in expectations. For example, Apple, Google, and Facebook have very high sales per employee, but Cognizant, which is a consulting firm, they have very low sales per. They're very dependent on wages. So Cognizant would be like the McDonald's of the consulting world, right? Goldman Sachs and Stone. Goldman Sachs. When I first went to work on Wall Street, it was pointed out to me Goldman Sachs revenue is like $1 million at the time per employee. Okay, and that's because they do institutional, not retail. So when you look at investment bankers and institutional stuff, Goldman Sachs stands out way different than any other Wall Street investment banking firm in terms of revenue per employee. And the same with this firm StoneX, which is about $1 billion market cap company. Whereas if you look at Citi and Westpac, they've got a lot more employees and a lot less revenue per employee. So there's a big difference within industry too. And so inflation is transitory, and wages for poor people don't really matter so much to the stock market right now, but we are seeing the 10-year treasury fall to 1.42%, down about 20 basis points. And as we see the expectations of the market saying, yes, this inflation is transitory, rates can come back down, and growth stocks went back up, and that's why PEs went up. Okay, PEs went up because the view today is that the inflation is transitory. In banks, you know, as I say, we're seeing the growth stocks go up. Okay, so Square, PayPal, MasterCard, Visa, American Express, any payment system stocks were up significantly this period, whereas the US banks were flat and European banks were down. And Europe has its own set of issues. But the good thing about US banks is that they're now going to start to expand their loan balance sheets, and they will lend more money and they'll get more interest income. But when interest rates go down, they'll make less on those loans. So it was a net neutral for the banks to see wages going up, inflation going down, interest rates going down, but loan books going up with recovery. And they need to expand their loan books. Bitcoin stabilized. So, you know, I've been a long-term follower of Bitcoin. I don't bring it up that much anymore, but China is going to crack down on mining. And so that was a concern for Bitcoin. And one of the concerns is that mining consumes electricity, and it consumes a lot of electricity. And Ethereum is making a shift to not using electricity, to proof of stake. That's like saying we have shareholders who will vote. We now have a broad enough range of shareholders who can vote for the next block, and we don't need to use electricity in proof of work. So they're shifting to a non-energy, not as expensive energy consumption model. And it was always that they would shift from proof of work to proof of stake and use less electricity. So, and that's now happening. So just so you know what's going on there. US banks, Wall Street, oh, they'll beat again. So Goldman Sachs is expected to make $10. And every quarter in the last 5 quarters, they come out and they make 50% more than expectations. So they're expected to make $10. If they make 15, the stock probably won't go up, right? Because people say, oh, this is another windfall from the Fed trade. And Goldman Sachs really only started to move when interest rates went down, and we saw an expansion in the profits from the interest rate spread. But now they continue to make money on the Fed buying all these assets and the Fed trade. And if they make $15, it adds $15 in cash to the company's balance sheet. It's $15 after tax. That's money. So eventually, investors are going to have to recognize that this is real money. It might be a windfall, but it is real money. So if they make $15, I'm saying I think the stock price should go up $15. So we're still in Goldman Sachs. We're still seeing this whole. Well, would you like to describe the virtual cycle so that people can get a break from my voice?
Yeah, well, I think that leads well into the next slide. I think it's Goldman Sachs earnings preview. Because one of the macroeconomic themes we've discussed is the virtuous cycle, where cheap credit and rising equity valuations are a currency that companies can use for mergers and acquisitions. And now that we've completed the first half of the year, the value of M&A activity has set a record of about 1.74 trillion US dollars. That's more than triple the first half last year, pandemic affected, of course, but about 35% above the first half in the year before. So M&A activity is white hot, and we've provided a link in the research report to a Wall Street Journal article, which is summarizes the state of the M&A industry. Why is that important for Goldman Sachs? They're consistently a leading M&A advisory firm, commanding 20 to 22% market share. So they're a beneficiary of that theme. And of course, the Fed trade, the liquidity and generally volatile pricing in asset markets is benefiting the equities and fixed income, currency and commodity trading divisions. So the business is performing very well in this environment.
Yeah, and it's so we've got the Fed windfall versus interest rates, right? Okay. And consumer products are really boring coming into earnings season. So remember last year we had the clicks and snacks analysis where people were pantry stuffing. So they were buying consumer products, they were buying food, they were stuffing the pantry. Who's that one? What was that one? That sounds like an airplane.
Drone.
What?
A drone.
I think it's construction.
Oh, is it? Okay. So consumer product, very boring coming in. Food, very boring coming in, except Campbell Soup announced earnings. And Campbell Soup said, we have inflationary costs and we don't have the pantry. We have tough comparisons because of the pantry stuffing a year earlier. So big disappointment out of Campbell Soup. It fell. And I think that's a danger sign for consumer products and for food. The big change in consumer products this month was that Louis Vuitton, Moet Hennessy, and Kelly, can you name some of the brands? They have so many different brands other than Tiffany, but Louis Vuitton has about 10 different brands, right? Celine. Can you rattle off half of Givenchy, yeah.
Hermes.
They don't know. Hermes is separate. They don't own Hermes. They own cognac. They make Hennessy. They make champagne. I don't think they've got a lot of different brands, right? So, but their market value went up to 336 billion, and it eclipsed Procter and Gamble by 2 billion. So it's now trading at 30 times forecasted earnings, and Procter and Gamble is still at about 20 times forecasted earnings. So I would say that Louis Vuitton is a darling right now, and it's become the biggest market cap in the sector. And that I would say that is definitely some drilling upstairs, isn't it? Okay. And so Louis Vuitton has eclipsed Procter and Gamble as the biggest stock in the consumer product sector. In the food sector, it's still Nestle. So Nestle is the largest. It's boring coming into earnings season, but that earnings announcement from Campbell Soup would give us great pause to go into anything that was a follow-up on the clicks and snacks trade from before. So we would not be going anywhere near food stocks right now. But Coca-Cola is different. So I wouldn't think of Coca-Cola as food, even though they consume a lot of sugar. Who's going to talk about Coke?
Coke? We bought Coke about a year ago. In the midst of the pandemic, the share price had gone from $60 to 45, which was when we entered. It's now at 54. So our total return is on about 20%. But we would expect it to fully recover to the $60 share price. So we probably have 12% left in it, plus the dividend. So but it hasn't recovered as fast as we would have expected, given the accelerated reopening in most parts of the U.S. And of course, the U.S. business will be the first to see a real sales boost against the COVID 2020 comparables. They get about 50% of their revenue, or they used to get 50% of their revenue from live venues, sporting events, and bars and restaurants. They've done a good job of managing the balance sheet over the last year, which is why I think we've seen some, pretty decent returns. But there's a bit more in it.
Yeah, I think management's done a wonderful job in realigning those venue sales to direct-to-consumer sales to continue to keep operating at a good capacity rate.
That's right.
And when they And they've done a great job in transitioning, but when venues open back up, I think they're just gonna go nuts.
So our expectation is that North American sales are consuming to boost starting now. So
Yeah.
the next 2 quarters, and then that'll move across the globe depending on the vaccine rollout.
Nobody got my nuts joke.
Did you just make one?
I said stock's gonna go nuts, but isn't the cocoa nut in,
That's
isn't it made from cocoa nuts?
good.
I do these things, you know, it's too subtle, isn't it?
Maybe a little.
Yeah. It's a cocoa nut, right? It's a cocoa bean, no.
I thought it was
It's a nut.
I thought it was a cocoa leaf.
Okay, I'm stuck. Kelly, I'm stuck here. Kelly, you work on that and I'll work on this. Okay. So
Right. I have a question here
Coke is,
from
oh, that's,
Alban.
well, that's what's going on. What's
Yes,
the question?
that's right.
I need to read it aloud.
Ooh, Alibaba's down 30% from its highs. What are your thoughts about continuing to hold it as an investment? I think it's a great investment. I think that the world is dividing in two. And China is willing to deal with countries where the standards of the politicians may not be as high as the standards that the US says they will deal with. So in other words, China will deal with corrupt foreign officials, okay, what the US would consider to be foreign corrupt officials. And we know from the Belt and Roads that they go out to lend to own. So they'll go to Sri Lanka, they'll build a port, and then they'll lend them enough money to build it, and then they'll take ownership because they can't afford to pay. So, and that's the threat. I mean, I don't know the details of the Dan Andrews project that got canceled here, but it was probably a loan to own type deal, right? And there's a lot of that going on. So China wants to take over the world, and the world will be divided in two, like Russia versus the US. So the real friction point here is Taiwan, because they have the semiconductor manufacturing, and we'll talk more about that. But you've got Intel in the West, Samsung in the East, and you've got Taiwan Semiconductors stuck in the middle. So we do talk about the bat fangs, the Baidu, well, no, the Baidu, Alibaba, and Tencent, and I think that that in non-English language they will continue to be the place to be. So absolutely be in there. Now they are subject to government regulation, same way the US is. The government regulation coming down on the Chinese tech stocks is intense. Jack Ma had to go to Beijing and talk about Ant Financial and his comments about the banks not being properly regulated. And you probably saw the Dai issue. Does anyone here? I use Dai. I don't use Uber. Does anyone use Dai? Okay, when I'm traveling around, Dai's 10% cheaper. So I use Dai, and it's the same car with a different app. And I think Uber owns most of Dai. But they just floated, and then they got smacked because the Chinese government is looking at them and said you shouldn't have gone public. We told you we were looking at you. And so there's risk in the market on these Chinese stocks. And but taking the government oversight and regulation risk into consideration, I think you've got to own some Chinese tech stocks. And I think the bats are a good place to be. And I think Tencent's a good place to be. And we got out of that at a good price around where we sold it. I wish we were kind of just sticking in it for the long term. But I think Alibaba is something you got to be in. And Baidu and Tencent, I think it's worth having those as an allocation for some Asian growth. Yes, I do like it very much.
I mean, they're trading at a discount because of the political risk. There aren't too many companies that have 35% projected revenue growth for the foreseeable future, 40%, and are trading at less than 20 times earnings. And that is a direct result of the perceived political risk.
Yeah, I'm going to say something that that most Americans don't get it. When I first came to Australia, there was this this dialogue from Ronald Reagan about the evil empire in Russia. And you know, I'm an American, I'm reading all the news. And I come here and I'm reading a totally different slant on the Russian situation. And you have to go to a different country to get a different slant. I think all the noise that we're being fed by Trump about how bad China isn't as bad as, you know, the Americans are led to believe it is. Okay, so you always have to go to a different country to get a different perspective. So that, because I don't know about you, but I get frustrated as hell that every time I do a Google search, it always takes me to Australian sites, and I want to pretend I'm in New York. I want to pretend I'm somewhere else so I can get a balanced view, but we don't really get it. And I think that we're oversold on how bad China is.
And the reverse is true.
China oversells.
China is overselling how bad Australia is.
Yeah,
Really?
I think it is. Yeah.
And there are Chinese people who are frightened of coming here because of
because
violence.
not because of you, but because of Chris, Kelly.
I'm an Australian citizen.
Well, not because of us, we're American. I'm not.
So I became a citizen.
Oh, you did, yes, so did I. Okay. Entertainment is in constant flux. So we have seen jockeying and changing and trading in mavericks like Malone or Redstone or whatever. So there's this constant shift on distribution and content. And Sumner Redstone split CBS and Viacom, and now they're merged back together, and his daughter's running them, but they still have a majority of the voting ownership. AT&T bought Time Warner, then they just are spinning that out now to Discovery, and there's a summit in Sun Valley now. And this morning I saw that the head of Discovery says, we're just getting started on doing deals. So he's our new maverick, and he looked pretty slick with his sunglasses and his hair back, you know, today. Did you see the video? He was looking all the part, right, of the new John Malone mogul. And then they showed Sherry coming in and saying, you know, maybe Sherry's going to break it up. Maybe if they would get rid of this voting control, if she let that go, that stock's worth 2-3 times what it's trading at. It's got a deep discount because the ownership is controlled by Sherry. And if they let that go, that's worth 3 times as much. So it's frustrating that they're not part of the deal making flow, but this is a very dynamic deal making industry. And you know, one day we'll get that value. In the meantime, we get frustrated that it's worth so much more than it's trading for. Roku, I mean, sorry, but I think Roku's a bit of a joke. Do you know what they do? Does anyone have a Roku? You buy a device. It's a little tiny like widget, and it does streaming throughout your home, and it will do the Apple TV or the other ones. And its revenues are $2 billion, and its market cap is 50, and it trades. It doesn't make any profits still. I mean, the valuations on this thing are astronomical for a little device. So Comcast, well, Disney's the most valuable company, then Comcast, and Comcast's worth $250 billion, I'm going to say around about, and Viacom's worth about $25 billion, 1/10 of that, and Roku's worth twice as much as Viacom at 50. So the news this month was some rumors that Comcast might buy Viacom or do a deal with, Comcast might buy Roku, which why would you pay 50 for that? And then you have to pay a premium. And you know, Viacom said it's such a deep discount, but it's not freely trading. And then you've got Comcast and now Discovery talking about it. So deals are happening, and one day this will free up. The value will free up there. Stick with that one. Comcast is worth 10 times Viacom, and Roku is worth 2 times Viacom. Okay, so who's going to talk about now that I've
Great. They'll report on the 7th. This is Viacom. They've had a wild ride this year with the Archegos family office implosion, which led to major margin calls and sell down of the stock in March. But still, year to date, the stock's up 16% for us, trading at 10.4 times earnings, which seems like pretty reasonable. They have actually announced an acquisition today. Maybe this deal was hashed out in Sun Valley. Viacom will be buying Chile Vision, which is a free-to-air television network in Latin America. And so this will expand their content library and presence in the Spanish language. I think it's a strategic move for the company. So they are in a deal-making mood. I think that can be the case. I mean, any sort of sale of parent Viacom would have to be with the consent of the Redstones, and that's why, as Joe mentioned, there's this ownership discount embedded in stock. But it's great value, and in a industry that's transitioning, we might see some deals this year, I think.
And I'm not going out to see F9. I don't know about you, but it just doesn't interest me, right? That's the new Viacom movie, F9. Isn't that like the Fast and the Furious version 9, the next one in the series, right? I think it's called F9. Yeah. Yeah.
Yes.
Fast and Furious 9. Popular franchise. Yeah.
Yeah, never seen.
Yeah, not my thing, but it's very good, right? I mean, in terms of profitability. Pharmaceuticals. What we're seeing in pharmaceuticals is that, you know, the government or politicians want to lower the costs because they spend so much on Medicare and Medicaid. And so all the time they're trying to get costs down, bring along the generic companies, let the patents expire, less available for extension of patents, less for research and development, lower costs, and we're going to provide a benefit to people who vote. Now, of course, there's this new incentive. Let's get a vaccine. Let's approve Biogen, and there's a change in the groundswell in investors believing that the Fed, the Food and Drug Administration, will approve more and support research and development. So we've seen a run up in the biotechs, run up in some more excitement around it. Whether it's these things take a long time to unfold, but the stock prices moved pretty quick this month, and I would say it's not something I'm going to chase. But it's not something I would chase, but that's what we did see this month. And the way I remember, Biogen's Alzheimer's drug is really an amazing story. It's what, $50,000, $60,000.
Yeah, 56,000.
And does anyone have experience with Alzheimer's here? Anyone know someone who's suffered from it? You know people who've suffered from this. So yeah, and my headmaster suffered from it, so I knew something about it. But you get this gray matter, and then the Alzheimer's causes this protein to continue to develop. But the new way of there are a lot of failed drugs in the marketplace, and this one stops the protein from continuing. It doesn't make you better, but you don't get worse. Is that?
No, it's been irreversible.
It's been irreversible, but this could slow the problem.
Yeah.
And if it slows the decay, that's a good thing. But my understanding is that the Biogen drug doesn't reverse it. It slows the decay, but it doesn't do much harm.
Yeah.
And if it's not going to do harm, let's get it out there. Yeah. Because why not spend $50,000 a year to save the brain? So let's get it approved. So I think that the change is let's approve something that doesn't do harm, even though it doesn't necessarily do good, because it gives people hope, right? Which is a good thing. I mean, my headmaster, watching him go through it, it's not a nice thing, is it? No.
My 40-year-old wife, girlfriend, she got 40. She was no longer there. Like 6 years.
For what?
She lasted 40 to 60, 40 to 46 with it. And then, yeah.
And it killed her.
Okay.
Yeah.
Just with it.
Yeah. Yeah. Well, as I say, the headmaster from my boarding school had it, and it was like, it's scary stuff. Anyway, so there's hope. I've been trying to get the concept through that collective learning is a hockey stick move. So blockchain, artificial intelligence, CRISPR, and the ability for everyone to share information around the world in real time is allowing for cures for cancer. And so as Kathy Wood would say, you've got to be out there on the edge of new technology development where collective learning is driving these things. So I think there's a lot of R&D going on, and I think Kathy Wood's funds are in a lot of good places, and I think having some CRISPR technology. So people know what CRISPR is? Can anyone say what CRISPR stands for? So palindromic repeating, right? So you have this DNA that's in a coil, and then you can slice out one piece of DNA and replace it And it's, I just remember the palindromic repeating, but I forget the first bits. It's some very common words, but it's the palindromic repeating thing that's, anyway, it allows you to splice a gene. So I could change your eyes to brown and your children's eyes would be brown. I could change my skin to black and my children would be black. So you can just replace the gene, right? So if you have sickle cell anemia, you say, here's a new gene. It's powerful and, obviously very ethically controversial stuff. But yeah, gene splicing is really, really, really easy. It's the ethics and should we be, making Joe black? Should Joe be allowed to be changed, right? So, you look at gene mapping from 15 years ago, that was pretty exciting. But CRISPR is practical. I mean, it works. Viatris. So you want to talk about Viatris?
Yeah, so Viatris was formed late 2020, combination of our initial investment, Mylan, and Pfizer's Upjohn division, and it basically represents a portfolio of about 20 generic and off-patent branded products, named a few there that we'd be familiar with. And the management are now starting to execute on all the strategic imperatives that underpin this merger. And they had a great quarterly result last quarter, where they maintained their fiscal guidance for the year. They initiated a dividend as promised. They're very committed to paying out a decent portion of cash flow in the form of a dividend. So it's 3.1% yield now. And they've accelerated their realization of the cost synergies that were sort of outlined over 2 to 3 years. So they are making progress, and we expect as they continue to do so, investors will have more confidence in the improved financial metrics, and the stock price will follow. Certainly worth multiples of the current valuation of less than 4 times forecasted earnings.
Amgen and Medtronic. Who's going to talk about Amgen? They've got a late July reporting, so not a lot to report on that. Comment?
Yeah, there's not really much to add there. It's a very high quality business with a nice diverse portfolio of drugs that has traded at a very reasonable PE, 13.6 times. Also got an attractive dividend. It just seems like a very attractive reward to risk sort of investment proposition. We have successfully had a short-term trade or investment, and only to have the opportunity to buy again at a depressed level. As far as we can surmise, the stock's been overlooked by investors because they haven't really had any COVID treatment or candidates that have been promising.
So what's the difference between a pharmaceutical and a biotech? Okay, and the short answer is that pharmaceuticals are older. They have drugs that are coming off of patent, and they have patent cliffs. They still have some research and development. A lot of times they'll sell their research and development and just kind of milk those patents for what they're worth, and then they have patent cliffs. Okay, whereas biotechs tend to have bigger research and development. They don't have the so the difference between biotech and what the drug isn't that big. It's really more the cycle. So the difference between biotech and pharmaceuticals is less about what they're trying to solve than it is where they are in their corporate cycle, right, in their age. But so Amgen is the biggest biotech. It has some patent cliffs. It has a lot of good drugs, and it can be called a pharmaceutical, but it has more R&D and more in the pipeline.
Importantly, yeah, decent pipeline. So last month they had a new lung cancer treatment approved unexpectedly soon by the FDA. And that's forecasted to contribute peak sales by 2030 of about $2.2 billion, which is, in the context of the business, about 10% of the current year revenue. So it's important to have that deep pipeline and commitment to R&D to be able to keep replenishing.
You talk about Medtronic too.
I can. So they report late August, out of cycle, and we'd expect a continuation of what we've seen in the recent results. A lot of their customers are hospitals that are restocking the sort of consumable equipment that are used in surgeries. So the persistently, I mean, it's persistently high COVID infections have a sort of cumulative effect on hospitals, and they do prevent the resumption of other surgeries. And so Medtronic's in some ways are going to benefit from the reopening, and we're seeing their customers prepare for that, but it's been slower than had been anticipated, say 6 months ago.
So for what it's worth, and sometimes trying to add a personal slant to things, I play a lot of lacrosse. I needed a new hip. I delayed it 2 years. It was very painful. It got delayed because of COVID. I got it done, and I'm back on the field playing full, contact. So that's great. So it does work. I'm dancing on one foot again. Okay, internet bat fangs. This is what we really want to explain today. Lena Khan, Apple could be forced to sell off the Apple Store. Amazon says that their selection would shrink. Facebook says they might have to get rid of Instagram or WhatsApp. They're up in front of Congress all the time. It's always being looked at. They're under pressure. Facebook and Google might have to get rid of Maps and YouTube. So if these things get separated, will it go the way PayPal did and just blossom because it's in its own separate company? Will it blossom the way Energizer did? Will it blossom the way Dr. Pepper did when you take this division and give it its own legs and its own management, its own incentives for that division? There are a lot of moonshots within Google, like Waymo, that independently could really go places, right? Okay. So Microsoft and Netflix are not in the spotlight for now, but maybe they'll take some preventative action. Maybe they'll just spin off Waymo, or. So the Democrats have an agenda, and Khan is a large part of that agenda. Lena Khan is that, and the Supreme Court has Brett Kavanaugh and Amy Coney Barrett, and they'll push back. They'll support corporates, and they want to. There's a new act, the Ending the Platform Monopolies Act, that has been pushed through the House, the lower house, right? Yeah. Okay. And what Lena argues is that Amazon lowers consumer prices, but as you were saying, Steve, that they need to look at the market infrastructure. So in addition to being a retailer, and she said, and I would really recommend reading her paper that she wrote when she was at Yale. There's a link on here, and it's really, really cognitive. It's the word she used. Instead, she didn't say it's very interesting read. So Bat Fangs will have to sell divisions, and that doesn't mean that she's going to destroy value. Okay, PayPal, Ant. Okay,
and it may not be imminent. I mean,
it's not.
It is. Yeah, it's a changing landscape, and nothing imminent.
It's 10, 20-year battle. Yeah, she's 32. She's going to be there for 20 years. Well, 4 year, but she'll be around a long time. Alphabet.
It took the U.S. government 20 years to break up AT&T. They started the attempts in the 1960s and finally happened in the late 70s.
With a free administration.
Things move a little differently than in the days of Standard Oil, don't they?
Oh, sure, but I'm talking about AT&T.
Yeah, and I'm talking about Standard Oil.
Yeah, that was actually pretty rapid.
Was it?
Where they made new legislation and Teddy Roosevelt went after trusts. Yes.
I think we've got just the right amount of time to.
Okay. Alphabet's going to report on the
5 minutes, yeah.
28th. We're expecting $19.21 in earnings per share, which would be a 90% increase from this time last year. So year-over-year, 90% jump in growth. And there was a news item on Microsoft today. The Pentagon has canceled a contract for Microsoft to be the exclusive provider of the JEDI Pentagon Cloud Center. And instead, they're probably going to piecemeal it out to Microsoft, Amazon, and Alphabet. So Alphabet may be a beneficiary of this cancellation contract. And so the shares were up a bit last night.
That makes sense.
Yeah.
Semiconductors, you want to take us through to the end here, Steve? Is that all right?
Well, this is sort of your thing.
Well, no, I think we've all participated in this. There's 3 semiconductor fab manufacturers.
Yeah, you've got China, you've got Taiwan, and you've got the US,
No. You got Korea,
South Korea with Samsung.
Asia.
Yeah, you've got Taiwan.
Yeah.
Which is non-China. Then you have some Chinese domestic fabrication plants.
Yeah, they're, whatever. I mean, they keep trying to build and fail, right?
Yeah,
I
they
mean,
don't have it. I mean, really, the Taiwanese are the most advanced
Yeah.
technologically.
Yeah.
And that's what makes Taiwan such a hot button issue right now. And this will probably be one of the major conflicts between the US and China, in that there is an implicit defense pact between the United States and Taiwan. It's not explicit. So there's been this sort of regime of strategic ambiguity that the US, in the event that China tried to take over Taiwan, Taiwan would be defended. And there's a number of, over the years, there have been arms sales, et cetera. But that is really the hot button, I think, in the US-China conflict right now. But what we're now seeing is a major push to bring the manufacturing fabrication plants to the United States, and a $250 billion piece of legislation just passed that will support the semiconductor industry for domestic manufacturing production. And that'll roll out over the next 10 years.
Now, Qualcomm, let's just quickly, Qualcomm reports on the 20th.
Yeah.
Airlines United placed a giant order, one of the biggest orders ever, 270 aircraft, mostly from Boeing, but Boeing didn't move. GE had a little bump out of it, and Airbus is 70 planes. But this is a very serious indicator of reopening plants. And there's a lot of smaller planes being replaced by single aisle jets for the local routes, as well as the Dreamliner, and the 737 MAX is going to be back up in the air. So on Boeing,
Well, the 737 MAX is back up in the air, has been since December without issue. Thank you. A report towards the end of this month, and there's a lot of sort of leading indicators for the continued reopening and recovery at Boeing. So we're looking at things like commercial airplane orders. That order book is growing for the first time since November 2019, I think. So the orders.
I'm going to go straight through because we're limited time. Why don't you go to Western Digital?
Sure.
Boeing's good indicators, stock price yet to go as much as we hope it will, as we plan for it to go up.
Sure. So Western Digital is the new addition to the 10 stock portfolio. It's a leader in storage devices and solutions, and the two main products are hard disk drives, which are sort of traditionally what we're familiar with in PCs, and solid state drives, or flash, which is a higher growth and more applicable to mobile devices where the business is really experiencing growth. It's one of the largest players in the industry, and it piqued our interest because they're starting to get some traction under the strategy outlined by a new CEO, industry veteran from Cisco, who was recruited or appointed about 15 months ago. And his strategy has been to focus on collaborating more closely with what they call cloud titans, the cloud businesses that need a lot of data capacity for the proliferation of data, of course, and also restructuring the two business units to be a little bit more market focused and responsive to customer needs, and of course cost discipline. So they've pared back some of their product lines and being a little bit more selective with R&D, and all of these efforts are translating to improved revenue and margins, greatly improved margins. Yet the stock price has been really languishing around the low end of the historical trading range. So being in a cyclical industry, they're typically traded at an 8 to 12 times price earnings multiple, and they're just below 8 times at the moment. So it looks like a pretty classic relative value sort of investment proposition, and so that's the current recommendation for the model portfolio. So
in summary, we have Goldman Sachs, Coca-Cola, Viacom, CBS, decent healthcare exposure in Viatris, Amgen, Medtronic, 3 technology stocks, and Boeing, and of course, I'm not sure if you have the supplementaries there, Joe, but Baidu and Alibaba.
And a good long-term performance. So I think we're right there on time, and we, are happy to stick around and talk for as long as you guys want. Any questions? Kelly, you want to?
I think that question on the,
Thank you. That's a good.
That's it.
Zoom's finished now or still going?
Zoom's finished, I think. Yeah.
Well,
I
thank
can ask a question then.
Go.
Yeah, correction, significant correction. Sometime in the next couple of years or not?
Yeah, well, just don't fight the Fed is the answer. And what the Fed is doing in liquidity creation, you do not want to stand in front of that. And so not until the Fed is done, then there could be some correction. Don't stand in
Everything
front
else
of the Fed.
catches up and no longer supported properly.
The stimulus from the Fed is gigantic in its commitment. So don't fight the Fed. So, yeah.
but if you define a correction as a 10% decline in the market.
It's more like 15% or something, not perhaps 20, but
Okay.
It could always happen.
Yeah, and it will. It absolutely, when it happened in February, March on NASDAQ, we had a 15% correction. That has now corrected back up. But we've had 15 or 16 corrections since 2010. That defined as a 10% decline in the market over a month.
Yeah.
So they happen, and sometimes for no reason whatsoever. It's
Well,
hard to
but I'm
define.
surprised, you had the surge in problems in India, and it didn't matter to them, did it?
No, maybe a couple of.
It didn't matter.
just we're all sort of told that, get the impression that everything's a bit overbought, because that's the only place mums and dads everywhere else is going to put their money now in the stock market.
Yeah.
And that normally sorts itself out at some stage with an adjustment
Yeah.
that can come swiftly. It takes
Well,
a long time. You'll do that proper.
During Alan Greenspan's time, let's go back to Jimmy Carter, right? In Jimmy Carter, we had very high inflation and 10% yields on 10-year treasuries and P's at 10. So when you have a 10-year yield on a treasury and price earnings ratio is at 10 times, that's accounting for a lot of inflation. And Greenspan's focus for 25 years was price stability. So for 25 years, you had the market until 2000. The market go, well, let's go to 98 or 97. That you got the price, the interest rates coming down, the P's going up to 20. And then in 2000, we had the dot-com bubble and new economy, and P's went up to 25. Okay, so now how low can you go? I mean, we're as low as you can go. And then we had the big scare 4 years ago where the concern was that inflation would turn negative and you'd have deflation. And then suddenly the market took a tumble on this risk. The prices were going to fall and people were going to postpone purchases and it was going to cause a global recession. And they got through that in 2008 with stimulus. So the Fed is desperately trying to create inflation, right? To keep it above zero. And they can keep it above zero. So printing money isn't inflationary, it avoids deflation. So when do interest now with the collective intelligence or the collective learning and the hockey stick increase there, I mean, how do you measure inflation anymore? It's hard to measure inflation, when you're using Google Maps instead of a Melway's, right? It's hard to measure it. So how do you change all your thinking on all of the measurements of inflation? And how do you just keep things moving? As Ronald Reagan said, if it moves, tax it. If it doesn't move, subsidize it, right? So
it's about big data now. And it's about big data now. So will inflation cause prices to fall? Will higher interest rates cause prices to fall? I don't know. We've seen that boom over my lifetime, and I don't know how you unwind it and how you get back to the days of Jimmy Carter. I don't see it happening. I mean, not in the foreseeable future, right? It's hard to imagine. It's hard to imagine. That's the big picture.
The problem is there's too many things happening outside anyone's ability. Well, the governments are playing mini gods, financial gods in a way. Can they keep doing that?
Well, what if the U.S. pulls out of Afghanistan and they just abandon an airstrip without telling, the Afghan military leaders, and the Taliban come in and start selling heroin to, all of our kids again? Okay, so I mean, that's bad, right?
A lot of people lost their lives for no reason. Back to square one.
A lot of Russians did in the 20 years prior.
Yeah, that's right.
So
A lot of Brits 150 years ago.
well, let's. I mean, we talk about a lot of stuff. We're off the sort of seminar thing here, and people should feel free to stand up and go if you have something to do. But from the Cold War, there were proxy wars all over the world. There was Vietnam, there was El Salvador, there was Cuba. There were all these proxy wars going on where, in North Korea. But that's East versus West. So where are the proxy wars between the US and China coming up? Is it Taiwan? Is it the South China Sea? Is it Sri Lanka? Is it Africa? And there are going to be proxy wars, and they may not be as physical as they are cyber, but there are going to be proxy wars like there were in the 60s and 70s and 80s. And I think that the facing off of the US versus China is a big issue. Because China's got long-term ideological plans to take over the world. I don't think they're hiding that. And the US is saying, no, you're not. Right? So I think the new face-off between East and West is something we're going to have to watch closely over the next 10, 15 years. At least, right?
Yeah, I think there'll be a focus on supply chains. The pandemic sort of accelerated that refocus on where manufacturing is happening. And we'll probably see more domestic US manufacturing, particularly in the technology space. But just going back to your question about the current valuations in the stock market, it really is relative analysis right now, because
Where do you go into a house?
equities compared to other asset classes look like great value.
Yeah.
Really great value. With growth, we had 27% growth in earnings last quarter. We expect similar growth in US corporate earnings. We'll see how that comes in, but that sort of growth is going to drive PEs down probably. We'll see. But
Where else do you get that
19 or 20
value? I mean,
19 or 20 times earnings for 25% growth for the next few quarters is not bad.
It's very good, yeah, but I wouldn't necessarily buy Louis Vuitton at 33 times earnings, right? Get Procter & Gamble with very little growth for 20, right?
Yeah.
So I think you're better off in Apple, Facebook, Amazon, Google, Netflix, and those types of companies. I think there's still a place to be.
Yeah, growth at a reasonable price, particularly in the case of Alphabet.
Not Roku. Not Roku. But I think you're right. When's the correction? And they'll come.
Yeah. Well, no one really knows. I know that, but it's really.
So from 2000 until 2005, the market fell 50%. Don't be shy. Well, the market fell 50% from 2000 to 2005, right? Why?
Well, it's like the stock market correction in 87.
Well, that
probably just you have the states as well. I'm just sort of.
that was pretty short term, actually. That was an interest rate kick and a precautionary increase in interest rates by the Fed.
Yeah.
And that's the trigger there. So it got frothy, but it fell and it recovered from that pretty quickly. The 2000 to 2005 one, that hurt. That was that was 2-3 years of just every day coming to work.
mean, that was a tough time. But P's got to 25. P's got to 25 and it came back to 15 as inflation surged. So that's why it fell 50% for those 3 years. But it was.
But that 87 was about 40%, wasn't it?
Yeah, huge.
Straight off the top.
Yeah, it went straight down.
In 87.
No, 87.
Well, I was sleeping under a bridge in Yosemite National Park.
Oh, you're close to me.
I was riding my
Oh,
motorcycle across the country.
you're one of the lucky.
I had left New York and I was riding my motorcycle across the country and that morning I was sleeping under a bridge in Yosemite.
Well,
All right,
thank you.
thank you. But
See you again.
we'll see, well, I'm glad we got.
Yes.